Welcome to Yield Nerd, an educational show about how you can acquire and manage yield.
All right, Yield Nerds, we are on to episode 109. I figured I would call this Nothing Ever Went Wrong with a Bull Run, or is it a Bull Shark Run? I will let you decide, and I'm going to share what I learned and what I've done. And I'm going to introduce my surfer dude side of the personality, and I might be a scaredy crow along the way too. Well, we're at 265 something subscribers. Thank you. If you're new, remember to use the playlist called the Income Investing Roadmap. And please don't take my word for it. I do not have magical prediction powers. I am often wrong. Make sure you check what you see and do your own homework. Well, I thought I'd have three different agenda items for today's episode. One is a review of what I see in the last 90 days. And I'm going to introduce my duck and weave strategy. Maybe it's the surfer dude strategy, and lay out what I intend to do over the next 90 days. And this is my education I'm sharing with you. Remember to do your own strategy. Most importantly, I am not a wealth management advisor. I am not here to sell snake oil. I don't do product. I don't do politics. I share what I learn. And having said that, I want to sit here and applaud NVIDIA. Look at this amazing thing in the last 5 years, 1,853% growth. Absolutely stunning. Hats off. The whole world should stop and salute them. In the meanwhile, my pathetic portfolio in the last 3 months delivers 1.45%. Oh my goodness, what are we doing wrong here? It looks like I should give up and go buy NVIDIA. Let me just check something really quick. Are you still listening? You want to listen to the dude who made 1.45% when you can go buy NVIDIA that makes 1,893%? In case you are, I just thought I'd point out the PE ratio of NVIDIA is a cool 102.59. So if they took all of their profits and they gave it to you instead of putting it back into the company, in just 102 years, you will get your money back. Nice job, NVIDIA. I hope it works out for the investors. I started reading some interesting papers. There is one from the International Monetary Fund called The Rise of the Walking Dead. These are zombie firms. Now, what's a zombie firm? A zombie firm has more debt payments than earnings. So just taking all of their earnings and making their debt service payments is not going to cut it. They have to borrow money to pay debt. And you do the math. This was very interesting to me. We are north of 20% of companies that will be in a position already where their earnings cannot service their debt. Forget about paying off the principal. That ain't going to happen. They can't even pay off the debt service payments, the interest payments. So there are going to be a ton of corporate bonds coming into the market. And you're going to see that north of 20% of the companies are in there. I don't know if it concerns you. It concerns me. And so my wonderful value investing portfolio in the last 90 days has done pretty well. Dillard's went up by 13.37%. Pioneer Resources went up by 8.13%. And these are all companies that met the Magnificent Seven or my value investing filters. Chesapeake Energy, 9.3%. Cal-Maine Foods, one of my favorites, 19.72%. And so I looked at all of these and said, Chevron, forgot to mention that, another close to 9%. And here is what I did. I took my chips and sold most of my equity positions because I am terrified of what is to come. If the entire world has to chase one stock, that party may last, but realize that what NVIDIA calls revenue, meaning AI data center revenue, the rest of the world calls CapEx. Let me explain that again. Facebook is responsible for 14% of NVIDIA's revenue. Look it up on their latest quarterly report. Meta, I guess I should call it Meta, is responsible for 14% of NVIDIA's revenue. And if you look at Facebook's own report, Facebook said they spent $25 billion in capex. nvidia had $13 billion in revenue from Meta. In other words, 50% of capex from these big companies is being spent on nvidia, and we're sitting here celebrating nvidia. What that also means is these companies that are pouring gasoline over AI, they either should see new products that they can use to charge you and I as customers, driving inflation potentially to a great extent so they can pay back the NVIDIA charges, or they may need to create AI agents where they can get rid of huge amounts of costs. If they don't do either one of these, then the NVIDIA run may be in trouble. Hey, I'm not shorting NVIDIA. I have nothing against NVIDIA. I'm a capitalist. I want you to win. I am reacting to news like this saying the world cannot survive on one stock, so I cash my chips. I cashed most of my chips at a profit, and I got out of my own value investing and filters. I have a really, really small portfolio left, which I might get rid of as well over time. And so Yield Nerd met Scaredy Crow. That's my surfer dude, personality. And I've decided that this is not the equity market for me, and I am going to come back and I am going to participate in equity, just not with this kind of hysteria going on. And so I still am going to participate in that awesome money party going on, just on my terms. And I'm still going to keep a low risk approach, but I'm not chasing the growth stocks. But so I've introduced a couple of caveats. The first thing I told you, I got out of my value stocks. I am sitting here anticipating the market will keep going up in the near term because it's punch drunk. And when the growth market goes up like that, and simultaneously somehow we think that consumer demand is not going to be there, energy stocks are going down, so I sold most of them as well. And my instinct is that politics is going to come into play when the spending bill shows up. And at the end of April, there will be some kind of yield event. Now, I am no magician. I remember you have to check anything I say, use your judgment. But in my assessment of the devil and the deep sea walk, I sold the value stocks. I've converted them all into 60-day T-bills that I can mature right around April 30th, May 1st week, something like that. And I'm going to see how things work out in the middle of April. And if the spending bill does create tremors and the growth stocks all of a sudden lose their footing, I might buy some of them, again, using my filters. Otherwise, I'll apply the value filters, but I'm not really trading in equities short of some miracle between now and the middle of April. And here is what that did to me. Remember, I still have ETFs, so this is showing still some level of equities. And so I am now at 95% fixed income. And of that 95%, you can see my fixed income is 95. All of my stocks are US based. International stocks are at 0%. I don't have too many large company stocks. I just have small company stocks, and that is it. I am sitting at that precipice. The scant equity that is there is still a couple of energy stocks that I am sitting on and waiting for a little bit more returns if I can. Otherwise, I'll send them away as well. I do have a couple of preferreds that are trading below par. So PGE, the preferred actually pays 6.6% now. American Home is already at 6.25. It pays something like 6.5. And so I'm sitting on some of these preferreds and a handful of these stock where I got the call wrong. UFP, I made a mistake. I thought UFP was a really good value. They forecast a down year and it crashed. Consol Energy said coal prices are going to be down for the rest of the year. They crashed, so I am sitting on them, not yet with the wherewithal to sell them at a loss, so I'll get around to it. And Archer Daniels Midland I've had for 2 years, and when they had the debacle with the reporting, my portfolio went down with it. But this is a minuscule portion of my portfolio. For the most part, I'm sitting on these 3 ETFs and 5 or 6 equities and the rest in fixed income. Within fixed income, I think I've told you before, I am hiding behind T-bills. That's 85% of my portfolio. My ETFs are around 13%. They produce a very healthy dividends, most of them monthly, of up to 11% annualized. And if you look within fixed income, you can see that more than half of my portfolio will mature within 90 days, which really is 60 to 75 days around the end of April timeframe. And I do have agency bonds that are at par with the longer duration that I picked up, 6% or north of that. That is it. So what do I plan to do for the next 90 days? I'm going to wait until the middle of April and I'm going to run the upcoming earnings screen, which has worked very well the last time. And I'm going to be the cool, scared crow. The cool, scared crow stands among sharks, but it doesn't engage in anything. And between now and another month, I'm just going to sit, T-bill, and chill. And towards the end of April, I'll see if the spending bill is causing any problems. If it does, I'm going to jump into equity. Otherwise, I'm happy with 5.5% T-bills. That is my strategy. Remember, you do you. Even a blind squirrel will find a nut once in a while. Don't trust me. Do your own homework. Thank you for watching Yielded.
Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.